Welcome back to another video, everyone. In this video, we are going to dive into the anatomy of options. I'm going to go over different topics such as options contract breakdown, calls versus puts breakdown, picking an options contract, and the pros and cons of options trading. Now, in the last video, I explained what options are and I explained the basics of calls and puts. Now I'm going to explain calls and puts and options, but I'm going to showcase real stock examples so you have a better understanding. Now, first and foremost, just to recap everything from the last video, as I mentioned, the only two things you guys need to know is about calls and puts. That's what options are made out of. Calls is when you profit when the stock goes up. So you make money if the stock goes up. Puts are you make money when the stock goes down. So if you're buying call options, you're basically going to make money if the stock goes up. If you buy put options, you only make money if the stock goes down. Now, the main thing I want you to understand and take away from this is when you are trading options, there's two things you can do. You can either buy options, right? You can either buy calls or buy puts, or you can also sell options. You can sell puts or sell calls. Now, there are two different ways of trading. There are two different methods of analyzing a trade, or depending on what you're looking for. What we're going to focus on, we're just going to focus on buying options. We're not focusing on selling. Selling options and buying, what is the difference? Just so you are on the same page. Now, if I buy a call option, I have the right to buy at a predetermined price, but I don't have to buy. But if I sell a call option, I'm obligated to sell at a predetermined price. If I buy a put option, right, I have the right to sell, but if I sell a put option, I'm obligated to buy. So when you're selling options, there's a lot more risk, right? You can lose a lot more money. But when you buy options, your only risk is your premium amount. So here, there's a lot more risk. Now, there are certain strategies to offset your risk and certain strategies people implement. I'm not going to cover those strategies because that's going to get extremely complicated. The only thing we're going to focus on is buying calls and buying puts and just focus on being option buyers, and that's really about it. But I want you to know that you can also sell options, you can sell calls, sell puts, but it's just far more complicated and more riskier, right? So be careful, and when you are trading, make sure you're not selling, you're buying. And if you are selling, understand why you're selling and understand the strategy behind it, okay? Now, let's go through an options contract breakdown. A contract gives the buyer the right to buy or sell the shares at a set price, depending on if you have a call or put. If you have a call, you have the right to buy. If you have a put, you have the right to sell, right? That depends all on you when you have an options contract, right? Option buyers pay a small premium, known as a deposit, to control the underlying asset. So when you buy an options contract, right? Once again, when you buy an options contract, you're paying a small deposit, you're paying a premium to control the underlying asset, right? The underlying asset known as a stock. You pick your strike price and expiration date. So let's say I want to control stock Apple. I want to control stock Apple. I get to pick at what price and until what time. And those two are going to determine my premium price. Now, obviously, if I have a further expiration date, I'll pay a higher premium price, right? Obviously, if I have a closer expiration date, I'll pay a much more cheaper premium amount. So it all depends on, obviously, different factors such as strike price, my expiration date, all these things play a role, and I'll break that down once we get to it. Next, call contracts profit when the stock goes up. So the call contracts only make money when the stock goes up. Once again, this is if you're buying options. If you buy a call contract, you only profit when the stock goes up. If you buy put contracts, you only profit when the stock goes down, okay? Contracts expire on Fridays. So all contracts expire on Fridays. So when you're trading options, keep that in mind. All contracts expire on Friday. There's a few exceptions like SPY. If you trade SPY, SPY doesn't only expire on Fridays. They have other days of expiration, but 99.9% of options, the main typical expiration date is on Fridays. So if you do pick an expiration date, most expiration dates are going to land on a Friday. Okay. Next, contract holder can exit their position at any time and sell the premium. So let's say you do put a deposit down for a stock, you do buy a premium for $1.40. Let's say your expiration is in 2 weeks. You do not have to wait those 2 weeks. You don't have to wait for the full 2 weeks to come by for you to sell your contract. You can sell it the next day. You can sell it the next minute. You can sell it the next hour. You do not have to wait for the full time period when you are trading options. Right now, let's dive into buying call options, right? Buying call options or buying a call contract is a contract that gives the buyer the right to buy the underlying security, but not the obligation, meaning you don't have to buy it. If you want to buy it, you can, but you have the ultimate right. Your max loss is the premium paid. So when you're buying call contracts, your max loss is only the premium paid. So if you paid a $320 deposit, that is your max loss. You cannot lose any more than that, right? Next, you do not have to buy the shares. You can flip the premium, right? So you don't always have to execute your contract or exercise your contract. You can just flip the premium. You can just flip the deposit. So if you paid a $340 deposit for some shares, and let's say the share goes up, you can sell this deposit for a higher price. Let's say for argument's sake, $450. So you'll make a $90 profit. So you can flip the premium and you can make money on just flipping the premium. You don't have to execute your full contract. And next, you buy calls when you anticipate that the stock will go higher. So you only profit when the stock goes higher. That's the idea of buying a call contract. Next, let's go through buying a put contract. This is a contract that gives the buyer the right to sell the underlying security, but not the obligation. So you don't have to, but you have the full right until your contract expires. Your max loss is the premium paid. You do not have to sell the shares. You can once again flip the premium. You buy puts when you anticipate that the stock will go lower. That's when you profit. So that's the basic fundamentals of calls and puts, buying calls and buying puts. Now let's go into an option contract and break it down. Now, when you guys look at an option contract, you have to understand that each contract represents 100 shares. So if I buy one option contract, I am controlling 100 shares. If I buy 5 contracts, I am controlling 500 shares. 10 contracts, 1,000 shares, 20 contracts, 2,000 shares. Now, the formula for options, what you have to understand is you have to pay a pre-contract fee per contract. So depending on who your broker is, brokers usually charge, let's say, a 50 cent per contract fee. Let's say your broker charges 50 cents per contract. If you have one contract, you're paying 50 cents. If you have 5 contracts, you're paying $2.50 per fees, right? So that's another added cost. And then there's a base fee. A lot of brokers have eliminated this, but if your broker does have a base fee, let's say the base fee is $7 and then you buy 5 contracts, you're paying $7 plus $2.50 to execute one order, and then the second order, which is to exit your position. Once again, go through your broker, see what your broker is charging. As I mentioned, a lot of brokers have eliminated the base fee. A lot of brokers applied depending on what who the broker is. So just kind of figure that out. If you are trading options, just remember commissions are very, very, very expensive. Now, option premiums. Let's break premiums down a little bit more. Now, if I buy, let's say I look at stock ABC, and the premium for one contract is $1.50, that means I have to, if I want to buy one contract, that means I'm buying 100 shares. Remember, one contract equals 100 shares, 2 contracts either equals 200 shares. So what that will do is that the cost of owning the contract will be $150. obviously plus the commissions and fees, right? So if I want to own one contract, it's $150. If I want to own two contracts, that's going to be $300, right? A lot of people get this wrong because they think, oh, the premium is $1.50. That means I only have to pay $1.50. No, $1.50 is for one contract. Remember, one contract has 100 shares. So 150 multiplied by 100 is giving you $150 per contract. That's what you have to pay, right? Now let's break some things down, right? Let's say we are looking at a stock, right? The stock price is $200, okay? Now, the question people have is, how is the premium established? Now, the way the premium is established, it factors in a few things. It factors in expiration, and it factors in strike price. Now, obviously, there's a lot more reasons that go behind the premium amount, right? And we're gonna break that down in the next video. But the two things we're gonna focus on is strike and expiration. Let's say the stock is trading at $200 right now. So right now, the stock is trading at $200. So I'm gonna give you guys three scenarios. In the first scenario, we buy a strike price of $250. In this scenario, I anticipate that in 2 weeks, the stock is gonna go to $250. For me to control this for the next 2 weeks, I have to pay $1.50 per contract. So I have to pay $150 to control 100 shares at $250 for the next 2 weeks. Now, if I do the same exact thing, right, in another scenario where I'm like, you know what, instead of 2 weeks, I want to control it for 2 months, right? I want to control it for 2 months. Now, if I want to control it for 2 months, if you look at this, my premium gets much higher because I have a lot more time. The only difference between scenario A and scenario B is in scenario A, I only have 2 weeks. Now, if the 2 weeks come up and I don't trade the stock, or the stock doesn't go up, or it doesn't move in my favor, I lose my full premium amount. So if my premium amount is $150 per contract and I have one contract, and in the next 2 weeks, the stock doesn't go up or I don't exercise my contract, I lose the full $150. In this situation, instead of me having 2 weeks, I have 2 months. Since I have 2 months, for the same strike price, same stock price, same stock, same everything, the premium becomes a lot higher because I'm buying more time, right? Now in the third example, if you look at it, this I have 2 months out, very similar to a situation B, right? But the difference is my strike price is higher, meaning there's a lower probability of the stock getting there, which makes the premium a lot cheaper. Now, obviously, these premiums are not exact. I'm just making up numbers. There's other things that go behind it. But what I want you to take away from this is what makes the premium go up or down, right? And the two main things are obviously the strike price you pick and how far or how much time do you have. If my let's say contract has 2 years or 1 year, obviously the premium will be higher. But if let's say my strike price is at $700 in 2 years, premium might be cheaper because the probability of it going to 700 is very, very low. So there's a lot of different things that go behind a full option premium, right? So let's break down a real example. So in this example, we have Mark and we have Joe. They're looking to trade stock AMD. Stock AMD is trading at $32 right now. That is what stock AMD is trading at, right? Mark wants to buy a call option on stock AMD. So Mark says, you know what? I think AMD is going to go up. So I'm going to buy a contract that expires on January 3rd, 2020, right? So I'm going to pay $1.50 for one contract. He pays $1.50 for the contract, and Joe is the owner of the contract. He's the one selling the call. Mark is buying. So in this situation, Joe collects the premium. That's how Joe gets paid, right? And Joe sells the right to Mark to buy AMD at $32, and the expiration date is January 3rd, 2020. So in this situation, once again, Joe made $150 in the premium amount because that's what Mark paid him. But in return, Mark has full control of the following. Mark has full control of 100 shares at $32 per share until January 3rd. Now, Joe gets his $150 regardless. Now, obviously, if the stock goes to $40, Joe will lose a lot more money. But if the stock stays at 32 or below 32, Joe profits and he gets to keep his shares. Mark's goal right now is to anticipate, or hopefully AMD goes above 32 bucks, and he has until this time frame. So Mark's cost on the contract is $32 per share plus $1.50 per share. So for Mark to make money, the stock has to go above 33.5, which is known as the break-even price, and I'll break that down in one of the upcoming videos. So the break-even price has to be above 33.50, meaning that if Mark is going to make any profit, the stock has to be above 33.50 before this date, or it has to move up in a very aggressive manner, and I'll show you what I mean when we cover the option Greeks. Right. So now let's look at all of the scenarios. Now in scenario A, right, this is scenario A, we got scenario B, C, and D. Okay, now let's break down each scenario right here. Okay, now today is, let's say, October 12th, 2019. The contract expiration date is January 3rd, 2020. In the first explanation, or the first scenario, we are paying $1.50 for the call premium. Once again, if we buy a call, we are anticipating that the stock's price will go up. The strike price is $35. Stock right now is $32. And this is today's date. Let's say 1 month goes by and we go to this scenario. 1 month goes by and we are on November 12th, 2019. In that 1 month, the stock's price stayed the same. If the stock's price stayed the same, right, and we own this contract that's $35, that's expiring January 3rd, 2020, our call premium that we paid $1.50 for will decrease now because now there is less time. When we bought this call contract for $1.50 on October 12th, there was more time that we had. Now we lost 1 month. Since we lost 1 month, what has happened in that 1 month? In that 1 month, the stock's price stayed the same. So our premium or deposit has went down. So if we wanted to sell our premium right now and exit the trade, for argument's sake, it would be maybe, let's say, 80 cents. So we could sell it for 80 cents right now, maybe 90. I'm just picking random numbers. There's a whole formula that goes behind this known as the Greeks, which I'm gonna break down in the next video. But for argument's sake, let's just say it goes to 80 cents. I can still sell it, I lose money on it, but I can still flip the premium and lose money on it. Now let's say on the second scenario, today the stock's price goes to $18. Now the option premium, instead of it being 80 cents, it might be, let's say, 5 cents. Why 5 cents? Because A, you lost time. That's number one. And obviously number two, look at the stock price now and look at the stock price then. So a lot of other things are factoring in this premium, and that's driving the premium down. Now let's say we're in November 12th, but the stock price goes up. It goes to $40. Since we still have time, right? Since we still have 2 months to go, right? What can happen now is our call premium might go up from 35 to, let's just say, I don't know, $10. So at this point, we can either still hold on to our trade, or we can sell our premium for $10 and sell it to someone else. Now, as an option trader, depending on what your strategy is, depending on how you want to trade, you might say, you know what, I'm going to sell this for 10. I don't want to hold on to it for any longer. You get out at 10 and you make a good profitable trade. Once again, that's up to you on how you go about it, but these are some of the scenarios. Now, if the stock goes all the way till the expiration date of January 3rd, 2020, and the stock is below $35, you will only lose your premium amount. You will not lose anything more, right? And that's the beauty of options. Now, next, options market timings. What are the market timings for options? Now, you can only trade options during normal market hours from 9:30 a.m. to 4 p.m. Eastern Standard Time. You cannot trade options pre-market. You cannot trade options after hours. With stocks, you can buy pre-market. You can sell after hours. With options, you cannot buy pre-market. You cannot sell after hours or buy after hours or sell anything. Trading only happens during normal market hours. Right here is the options breakdown. So if you guys take a look right here, this is how an option breakdown looks. It starts off with the ticker symbol, stock ABC, then it has the expiration time. This option contract is expiring January 12, 2019. Then it has something called the strike price, what price you selected. Then right here, it'll tell you if it's a call or a put, and then it'll tell you at what price, right? This is how a full options breakdown will look like. It's kind of like a ticker symbol for options, right? So if you have a ticker symbol for stock Apple, it'll be AAPL. But if you have a ticker symbol for stock Apple's option, it'll say AAPL, right? And then it'll have a lot of words after it, which will represent the full option. Okay, now let's just break down the benefits of options trading. The benefits of options trading is that you get significant gains with small amount of money. So you can make a lot of money by investing a little amount, right? Next, you're risking less capital in each trade, right? It doesn't require a lot of capital. That's completely up to you on how you want to go about options, right? You're able to profit in any type of market with multiple strategies. So depending on what strategies you know, you can make money in a choppy market, in a downward market, in an uptrend market. You can make money in all of the markets. Next, your only loss is the premium paid. This is if you are, once again, buying options. If you buy options, your only loss is the premium paid. And then finally, you can hedge using options. Hedging reduces risk. It's basically buying insurance. So there's certain hedging, there's certain ways for you to hedge, hedging strategies that you can apply that will allow you to buy insurance for your certain trades. So what some people do is they buy a stock and then they buy options to kind of protect their downside. So that's the benefits of options trading. What is the negative of options trading? The negative of options trading is there's very high commissions, way higher than stocks. There's lower liquidity, meaning it's harder to get in or out of some trades, right? You could lose your full investment amount, which is the premium, which shouldn't happen if you obviously have proper risk management. There's higher spreads, meaning that the buyers are at $1.20 and sometimes the sellers are at $1.80. So there's a 60-cent spread. So there are higher spreads when you're trading options. There's time decay, meaning you're gonna lose money each and every single day each and every single day if the trade doesn't move in your favor. So if you buy a call option and one day the stock stays flat, your premium will go down, right? With stocks, you don't take that hit. And obviously, finally, trading options is very complicated in understanding that. Now, just to recap everything, options is very complicated. And if you still didn't get the full idea or the full gist of it, just watch the next few videos. Hopefully they make things a lot clearer. I understand a lot of people have a major problem with understanding options. If you have any questions or if you're still having a hard time, go through the next few videos. After you go through the videos, jump onto the forum and ask your questions before you move on, because I completely understand of how complicated and tough options get.